This video has capital budgeting examples for Chapter 14 for Principles of Accounting 2. The first example that we're going to look at is a payback calculation. We're trying to determine the payback period of this investment. When we have a payback, if you remember from the chapter information, when we're looking at payback and we have even cash flows, we just take the amount of the investment divided by the annual cash flows to get the payback in years. However, if we have uneven cash flows, we need to calculate from year to year to find that information. And we do that by looking at what the balance is at the end of each year until that investment is completely paid for. So in year one, we have an investment of $15,000. And we have cash inflow of $1,000. So at the end of year one, we have a balance of $14,000. In year two, we have an additional $8,000 and a cash inflow of $2,000. So then we would add the $14,000 plus year two information. At the end of year two, we have a balance of $20,000. We do not add any more to our investment, so now we just need to determine in what year that is paid off. So we're going to add the cash flows each year until we get to 0. So we can see that we're going to end up in 0 sometime in between year 6 and year 7 here. At the end, and sometime in year 7. At the end of year 6, we have $2,500 left. So we're going to pay that off, and we're paid off in year 7. To determine when that happens, we take the amount divided by, or the amount left divided by the cash inflows, and we get that it's half a year. So the payback period for this is 7.5 years, paid off halfway through year 7. 6.5 years. Sorry about that. Paid halfway through year 7, so it's 6.5 years. The next example that we're going to look at is looking at the net present value of a project. So we have a company that is looking to purchase a 27,000 machine that would reduce our operating costs by $7,000 per year. The machine has a 5-year useful life and 0 salvage value. We have a required rate of return of 12%, and we're looking to determine the net present value of the investment in this machine. So we need our investment, cash flows, required rate, also called the discount rate or the hurdle rate. So our investment, we're going to put that in as a negative number. Our cash flows every year are that savings of $7,000. Our required rate of return is 12%. And we want to find the net present value. So in order to do that, we have a 5-year useful life. In order to do that, we're going to look at a net present value table. So when you're in Connect, if you click on the table, it will bring you to the net present value table. What you want to look at is for your required percentage and the number of payments. So we have a period of 5 years. We're looking at the present value of an annuity, which is annuity is if you have equal cash flows every single year for a period of years. So we have 5 years, and our required rate of return is 12%. So our present value factor is 3.6048. We're going to type that in, 3.6048. So to determine the present value, or PV, of cash flows, we take 7,000, our yearly cash flows, times our factor. The net present value of the project is the present value of cash flows plus the investment. That's why we put the investment in as a negative number. So this investment has a net present value of negative $1,766.40. This means that we would not take on this investment. Excel also has a formula for net present value, and in order to do that, we need to put our cash flows out into all years. So we have cash flows of $7,000 each year for 5 years. We would then equal, the formula is NPV for net present value. You put parentheses, click on the required rate of return, then put a comma, select all of the cash flows, close your parentheses, and then add your investment. You can see the net present value. Excel is a more precise than using the tables. Connect wants you to use the tables for your calculation. So if you use Excel or a financial calculator when you're doing your homework, or an online calculator, your homework will tell you you're wrong because they want the information from the tables. They want you to use the factor tables. Our next example looks at the internal rate of return. We have a donut shop that is looking at an $18,600 donut making machine. This new machine is going to save us $3,800 per year and allow us to produce a new style of donut that's going to result in the sale of 100,000 dozen more donuts each year. The machine has a 6-year useful life. The first question is, what would be the total annual cash inflows associated with the new machine for capital budgeting purposes? Well, what goes into our inflows are the cost savings. So we have cost savings of $3,800 per year. We also have that we're going to sell 1,000 dozen more donuts, and that the contribution margin per dozen is $1.20. So we also have the additional sales, 1,000 times $1.20. So the cash flows from this project, we add those two together, are $5,000 a year for 6 years. For this calculation, we're looking for the internal rate of return instead of the net present value. To calculate internal rate of return, we take the investment and divide it by the yearly cash flows. So we have an investment of $18,600, and I'm going to put that negative here, and cash flows of 5,000. And we're looking for our internal rate of return. So we're going to take 18,600 divided by 5,000, and we get 3.72. To find the internal rate of return, we go back to our factor tables. So we have, it's a 6-year useful life, and we're going to go along this 6-year line until we find 3.72. 3.72 falls between 3.78 and 3.68. So what that tells us is that internal rate of return falls somewhere between 15 and 16%. So you would say 15 or 16%. You can also use Excel to calculate a internal rate of return. So we want cash flows for 6 years. 2, 3, 4, 5, 6. So calculation is IRR. So we put IRR parentheses, select all of our numbers, and equal. So the exact internal rate of return is 15.64%. Excel wants the number from the table, or Connect wants the number from the table. So if you're working on your homework, make sure you're using the tables that are in Connect available for you. Number 3 says, in addition to the data given, assume that the machine will have a $9,125 salvage value at the end of 6 years. Then what is our internal rate of return? So we're going to add that salvage value in year 6. And I need an equals. There we go. And now our internal rate of return is 22%. This example looks at a full capital budgeting example. We have a division manager whose pay raises are determined by his ROI. So if you remember from the chapter where we looked at division analysis and we looked at return on investment and how capital projects can reduce our return on investment. So this project might jeopardize his bonus. Let's calculate some numbers and see how that happens. We have an investment in $3.5 million. So the investment is $3.5 million. And we're going to make that a negative number. And we have cash flows for 5 years. So 1, 2, 3, 4, 5. No salvage value. We have a rate of 6% or 16%. And so now we need to know what our cash flows are. So we're given an income statement with net operating income. So if you remember from cash flows analysis, that to turn income into cash flows, we have to add back the non-cash information, which is depreciation. So our cash flows are the net income plus depreciation. So we have cash flows of 1.1 million for every year. No, actually, what I want to do is this. Our first question is, what is the net present value of this project? So we have a rate of 16% with 5 years. So we would go to our table and get our factors. 5 years at 16% is 3.2743. So that is our factor at 16%. So for the net present value, we want to take our cash flows of 1.1 million times the factor of 3.2743 and then add our investment. and we get a positive net present value of $101,730. We can also do the net present value calculation in Excel, our rate with our cash flows, and then add our investment. And that's a more precise number, so it's just a little bit different from the calculation. For the project's internal rate of return, we're going to take the investment, so we want the positive investment divided by the cash flows, and we get 3.13. We want that number to be positive. Roughly 3.18. Not a dollar. There we go. We go to our table and we go to 5 years and we look for the 3.18. Well, that happens between 16 and 20%. Probably right around 17% if we had to estimate from this factor. So we'll say internal rate of return of 17%. Or we can calculate it with Excel. Internal rate of return precisely is 17%. I guess pretty good. 17.24%. The third question it asks is, what is the project's simple rate of return? The simple rate of return is also called the accounting rate of return. That is calculated by, instead of using cash flows, we use the operating income. So we take the operating income divided by the investment of 3.5 million, and we want a percent. So the simple rate of return is 11.4%. The question then, do we want to take on this opportunity? The company would be in favor of taking on this opportunity. It has a positive net present value. The internal rate of return is higher than our required rate of return, and the simple rate of return, or the accounting rate of return, is good also. Casey, the division manager, might not want to take it on because it's going to lower his return on investment. So even though it's higher than our required rate of return, it still isn't over 20% for that return on investment for division performance. So if we wanted Casey to take on this investment opportunity, we would want to calculate his bonus differently than by return on investment.